Time now for the Muni Moment. I want to bring in my guest, Lyle Fitterer. He's the Wells Fargo Asset Management head of global fixed income and head of municipal fixed income as well. Lyle, great to have you. You know, so far this year, we've talked a lot about how high yield has outperformed some of the investment grade credits. You make the case that maybe spreads are getting a little bit tight. Are you working on increasing the quality of your portfolio, or does the strong economy make the case that high yield credits should be something that we're still looking at?
I think high yield credits can still perform okay in the next 6 to 12 months, but I think you have to start the process of upgrading your portfolio. Spreads right now, if you look at where high yield is relative to investment grade in many sectors, you're at historically tight levels. And so what we've been doing is gradually looking to upgrade the credit quality of our portfolio, go into some higher AA or AAA rated issues, extend the duration a little bit, and prepare for what we think will be, eventually a slowdown in the U.S. economy. It may not happen until 2019, but by then it'll be too late to do that up in quality trade.
You know, it was interesting when you speak about the economy. Moody's just had a report out that states have done a really good job of increasing their revenue, and they're sort of putting cash back into their rainy day reserve funds. I wonder here, are you still nervous, though, about GOs because of maybe some of the other potential issues like pension obligations, for example?
Yeah, I think it's a good point. I think pensions are always an issue that we're concerned about. But I think, avoiding GOs because of pension issues is like saying you're avoiding corporate bonds because of leverage issues. I think you have to look at each and every GO credit specifically. What's the economic backdrop? What are the demographic trends? What's their tax burden? Do they have the ability to raise taxes and service their debt? So I think there are a lot of different things you need to look into. So I think some of the best places to actually have invested over the last 5 years are places like Illinois or New Jersey, where they've had pension issues, but you're getting paid for those taking that risk. I think you can monitor those pension issues. And so, again, I think it's a strategy of not avoiding every credit, but looking at what's the near-term risk and what's the long-term risk, and do they have the ability to fix their issues.